On the left, we have one of the world's largest oil companies. This company produced 791,000 barrels a day in 2018. We have Chevron. And on our right, we have the Challenger, formed after a merger in 1999 with roots that can be traced back to John Rockefeller. We have Exxon Mobil. It's time for stock battles. Hey guys, I'm Joseph Graff. Some of you might remember me from the stock analysis videos I used to make. Well, I'm going to be continuing to make stock analysis videos, but I've come up with a more, what I think will be exciting and fun theme. I'm going to be doing stock battles. So I'm going to take two similar stocks and I'm going to pit them against each other, and we're going to take a deep dive into figuring out which one might be the better buy. I'm really excited to be starting this new series, and I really hope that you all enjoy it. So with that being said, let's get it. So between Exxon Mobil and Chevron, Exxon Mobil is actually the bigger company in terms of market cap. Its market cap is $249 billion, while Chevron's is just $200 billion. Now keep in mind that a company's market cap is just its price per share times its number of outstanding stock shares. So it does give you an indication of the size of these companies. ExxonMobil is about 25% larger than Chevron. Between the two companies, ExxonMobil has a 5.9% dividend yield, while Chevron has a 5.2% dividend yield. These dividend yields are both exceptionally high. Oil companies tend to have higher dividend yields than your average stock, mainly just because they don't have a whole lot of options for how to reinvest the money that they earn. There's not a whole lot of rising new technologies that they can use to increase their profits, so instead they choose to give a higher percentage of their profits back to the shareholders. Now, ExxonMobil and Chevron both took pretty big earnings hits during the pandemic. I'll get into more detail about that a little bit later in this video, but both of them at one time, there was a lot of talk of them cutting their dividends. And actually, at one point, ExxonMobil and Chevron discussed a merger. This would have been one of the biggest mergers in history, and it really goes to show you just how hard both of these companies were hit by the pandemic. So both ExxonMobil and Chevron were hit very hard by the pandemic. ExxonMobil actually was up at around $70 at the end of 2019, and it dropped all the way down to about $34 last October. And since then, it's popped back up all the way up to $60, where it seems like it's kind of leveled out. Chevron had a pretty similar performance. It was up around $120 last November. It went down to $60 at its lowest after the pandemic hit, and now it's up trading at around $100. Some of you all might remember the time the pandemic hit and oil prices actually dropped in the negatives for a while. This was just absolutely crazy, and it was pretty much the perfect storm between the pandemic and these negative oil prices that both company stocks just took a huge hit. Both of these oil companies were able to bounce back, though, mainly because there has been more optimism about how the pandemic is going to play out, and I think people are a bit more optimistic that things will go back to at least some level of normalcy, that we'll have more travel and manufacturing going forward. However, both of these companies did post losses the last couple quarters, and they're really getting back into the swing of things, really just now starting to be profitable once again. So I'm very curious to see how they will continue to do as the economy reopens. So in these next two slides, I'm going to give you all a brief overview of some of the key financial points for both ExxonMobil and for Chevron. The first thing I'm going to talk about is debt to equity ratio. So ExxonMobil actually doubled their debt to equity ratio from the levels that it was pre-pandemic. It is now hovering at around 0.4, whereas before the pandemic it was at about 0.2. And what this essentially means is that they are operating with a lot more debt than they typically do. This isn't necessarily a horrible thing, but it certainly is a reflection of how they were hurt by the pandemic. Exxon Mobil also cut their capital spending by 30% in 2020. Once again, this was in response to the pandemic. Personally, I think this was probably a good move with how bleak things looked for a while. Exxon just was not confident that there would be a large demand for oil for some time, and as a response, they decided to cut some spending. This could have some negative long-term impacts, but across the board, a lot of oil companies were cutting their capital spending. So I think this was an appropriate reaction. If you take Exxon Mobil's earnings that they've already posted for this year, and then also add in the forecasted earnings for the next 2 quarters, they're expected to earn $3.59 this year. That puts you at a forward-looking PE ratio of 16.4, which really isn't too bad. The stock market's PE ratio is up in the mid-20s at the moment, I believe. So this 16.4 actually makes it look pretty good and really makes Exxon Mobil look like a value stock. As for Chevron, they also increased their debt to equity ratios in the pandemic, but not to the same levels that Exxon Mobil did. They too decided to cut a lot of capital spending for 2020, but the difference between what they did and what Exxon Mobil did is Chevron actually announced that they were going to be cutting spending from 2021 to 2025, whereas Exxon Mobil just announced that they were cutting their 2020 spending. So this was kind of an interesting move by Chevron. It kind of signals that they aren't going to be making as many investments here in the future into their oil production. And it's really kind of interesting. It could be looked at as a move to save some money, to save some cash, maybe reduce the debt that they have. So it could be a good move. But one way or another, it certainly is a different approach than it seems like Exxon Mobil is taking. So once again, if you look at Chevron's earnings forecast for this year, they're expected to make $5.40 for the year. This puts them at a forward PE ratio of about 19.2. This is a little higher than Exxon Mobil, but it's still pretty good in comparison to what the average stock in the Standard & Poor's 500 looks like. I actually think in the short term they'll do pretty well because I think oil prices are coming back up. I think as things are starting to reopen, there will be a higher demand for oil. So short term, I really do think Exxon Mobil will do well, especially over the next year or two. But long term, I really am not too optimistic. They really have not made a commitment to renewable energy, with the exception of biofuels. They really don't even talk too much about renewable energy. They're kind of just doubling down on their oil production. And while I do think that the world will continue to use oil, for the next 10, 20, 30 years, I think things are definitely trending towards more renewable energy use. Something that I did not particularly like was that Exxon Mobil actually sustained their dividend throughout the pandemic. And normally I think it's a great sign if a company maintains their dividend, but I personally felt like their earnings dropped so low and oil prices were getting so low that I think they would have been better off going ahead and cutting it. I think they've kind of elevated their dividend to this level where, it's almost horrific for anyone to suggest that they cut it. And I just am not sure that was a great business decision. As for Chevron, I'm also not too optimistic about their future outlook, although I am a bit more optimistic than I was for Exxon Mobil. Once again, they really don't have a whole lot of a commitment to renewable energy. They did invest $40 million. They and BP invested a total of $40 million into a Canadian geothermal company this February, which I thought was pretty interesting. I'm curious to see where they're going to go with that. And they do have some wind farms and solar farms, but overall, there's just not much of a commitment to renewable energy. They sustained their dividend throughout the pandemic, but my understanding is that they weren't in as critical of a financial situation as Exxon Mobil was during the pandemic. I think because they have lower capital spending. So overall, I thought they kind of played this whole pandemic situation a bit better than Exxon Mobil did. That's just my opinion. If you all have any other opinions, let me know down in the comments below. I'm kind of curious to hear what your all's thoughts are. So when I think about these two companies, I kind of like to think about what Warren Buffett said one time about how there's money to be made investing in what you call cigar butt companies. Now, these cigar butt companies, as Warren Buffett called it, are companies that are really just unloved. They don't have a whole lot of growth potential. And he compared them to picking a cigar butt off the ground and, picking it up, having one last puff, and then you're done with it. It's all used up. So with Exxon and Chevron, I don't think they have great growth potential, mainly due to their, large focus on oil. And it looks like moving forward into the future that we're going to see less and less oil consumption and probably see a transition to renewables. I think the stock market has kind of priced this in. I don't think anyone is super excited about either of these companies' growth prospects. But thinking about these two companies, I think oil is going to be around for at least another, 10 years, 20 years. I could still see the world using a lot of oil, 30 years from now. I think a lot of people have overestimated how fast we're going to transition to renewable energy, and we're still at the point where a lot of places it's just not cost effective to install big solar systems or wind farms. So I think oil is going to be around for a while. Now for these two companies, when I take a look at everything that we've covered today, I think Chevron is the better buy. I actually own some Exxon Mobil in a dividend reinvestment plan. I purchased the bulk of it back in 2016, and then I bought a few more shares around the time the pandemic hit. But looking back on it, I really think that Chevron is probably the better company. It is trading at a little bit higher of a PE ratio, but all the research I did on how both companies reacted to the pandemic, I just felt like Chevron had handled things a bit better, and overall, I think they're the better buy. Now, keep in mind, this is just my opinion. I'm not a financial advisor, and I really want to know what you all think. Do you all think Exxon Mobil or Chevron is the better buy? I think it's really interesting because, like I said, Exxon Mobil has a lower PE ratio, and it has a higher dividend yield, but overall, I just think Chevron's a better company, and it's a better long-term buy. So, anyways, please comment down below with what your thoughts are. And then also, let me know if you like this new video style. I think it's kind of fun for me. It's a lot less dry than the stock analysis videos that I was putting out. So let me know how you like it. Please hit the like button. Please subscribe to the channel. Thank you all for watching, and JGraph out.